All right, guys, welcome back to Wealth and Travel on a Dime. So today I wanted to talk about the age-old question: pay off your mortgage or invest? Now, we can speak to this because we actually made the decision between the two and followed through with it. And I'd like to kind of share our thoughts on it because a lot of the people have different takes on it. They just look at it from a financial standpoint. And I think that there's more to it than that. I think there's a financial side and I think there's a mental side to it. And I also think that there's one fundamental thing that nobody's thought about that may change your mind on what you do. Now, I want to start off by saying that the common adage, the old rule, let's say, has always kind of been if you have a lower than 3.5% mortgage, you're better off to just invest your extra money and just pay your mortgage. And I kind of feel like that rings true. But I mean, there's more to it. There's what tax bracket you're in. There is what kind of account you're putting the money in would matter. The property taxes on your house would matter. I mean, there's all these variables. So it is going to very much be for you to figure this out. But for us, paying off our mortgage first made so much more sense. And by the end of the video, you will understand why. Now, to give you a better financial understanding of this, if it's under 3.5%, and on average the S&P 500, which is a standard index fund that you can get into under the name of everything from like VOO, FZROX, I mean VTI's total stock market, still with the same return pretty much, you get 8% inflation adjusted pretty much every year. So it makes way more sense to do that if you only have a 3.5 or say lower mortgage, because you're going to make all that extra and you're only going to save 3.5%. Now that's the normal thinking. Now, while that math holds up, it doesn't take into account for a lot of other things, because while that 8% compounded over your 30-year mortgage is great, you're going to make a ton of money. There is no doubt in my mind. We have actually seen multiple years recently, where it's done 20, 25%. So you're going to make a lot of money. 8% is just a nice figure. But at the same time, and we have learned this firsthand, that if you take a mortgage and say it's $1,000 a month and you put an extra 100, 200, 500, whatever extra money you have at it, you're opening up equity. Whether that's important to you or not depends on your situation, what your plans are going forward. But the real point of it is, if this is going to be your forever home and you pay it off, you need that much less money in retirement, especially if you're looking at retiring early and this is your forever home. That means you don't have to budget for a mortgage. You don't have to budget for, say, PMI if you end up having to have it. You don't have to budget for all these things. It saves you so much money that you don't need to save and invest as long. That is where we have come to. Everybody said, why are you guys paying your house off? Now, we were still investing on the side, a small amount, but not compared to what we put towards paying off our properties. Both of our properties are 100% paid off, all right? Now, if you were to have drugged that out, because we actually had less than a 3.5% interest rate on our property, but we still paid it off early. And now, while we are slightly frugal, our budget monthly as far as bills is $1,300. That's not including food and gas. But the point is, we have those low bills because we don't have a mortgage or rent. All right, it really makes a huge difference. So now when we look at how much we need, say we go back to the adage of $1,000 mortgage payment, we have $1,000 less we need in retirement. Now, $1,000 less, when you convert that to say you were using the 4% rule, is a lot less money that you have to save for retirement. And I know that that's really hard for some people to grasp, but you have to think about it in terms of 4%. All right, so if you can pull 4% out of every 100,000, let's say. Okay, that's 4% for 100,000. Now, if your monthly mortgage payment's $1,000, That's a couple $100,000 you don't have to save for retirement. Listen to what I just said. A couple $100,000 you don't have to save. Now, when compared in that situation, technically, financially, it'd probably be better to invest. It really, really would. Because you're going to make so much money, it really does make sense. But we are also making this video in a rate of like people getting 8%, 9% mortgages. If you've got poor credit, I've seen 10% mortgages. Now, with that said, I've also seen when I was growing up mortgages at 14 and 15%. My parents had one. So it's one of those things where you have to decide the value of what you're trying to do. Can you sleep better at night if your property's paid off? Because if you can, then that's what you should work on. Because the mental side of this game is way more strong. Now, there is a middle ground, and I always like to mention this to people because if you want to do the best of both worlds, pay off your monthly mortgage of $1,000, put some extra towards the principal, and invest the rest. All right? And then when your investments get high enough, sell them, pay off the house. It's probably the fastest of both ways. But most people don't actually understand that interest matters. All right, there's calculators where you can look up how much interest you're actually paying. And I think that literally half the population doesn't understand this concept. You're watching this video, so clearly you understand what I'm about to say. But I would be hard-pressed to admit that more than half the world actually understands interest, whether it's car, house, credit card, any kind of loan. So when somebody says, check out my new truck I just got. I got that for 50 grand. And I go, you paid 50 grand cash for that? And they're like, no, it's financed. I said, you didn't pay 50 grand for that then. Which means you paid probably 70 grand for that car by the time you're all said and done if you're just making straight payments. It's just like that with a house. Let's say somebody gets a real good deal on a house and they get a $200,000 house. That $200,000 house is not a $200,000 house. So they say, isn't my house beautiful? I paid $200,000 for it. The first thing I'm going to say is, you didn't pay $200,000 for that unless you bought it cash. And they'd be like, yeah, I did. And I would have to make them understand that, no, you're paying $250,000 or $300,000 or maybe more for this house because you're on a 30-year loan. Now, the best way to do this is whatever helps you sleep at night. Investing and paying off your mortgage, having debt. I don't like debt. I don't like owing people money. So it drives me to work harder. It's actually good for me to have a little debt because it keeps me motivated. But at the same time, wake up every morning and know that your property's paid off. Now let's all be clear. You don't own anything. All right? The fact is you only live so many years, so you can only enjoy something for so many years. But that said, we all have to pay taxes, so you're never done paying. But I would rather pay less by paying off my home early. Now, if you get onto some of these calculators and do out the math of a 30-year loan, let's use the $1,000 a month. You take that out and look at how much interest you're going to pay over 30 years. And then you take the number at 8% that the house would have cost, having that $1,000 a month payment, and run it out 30 years, getting 8% a year. Unless you got an 8% mortgage, or a 7% mortgage, they're going to run neck and neck if they're 8 and 8 or 7 and 7 or whatever you want to put it as. But if you got half as much or less, if you're doing a 3.5% or less, financially, it makes more sense this way. But I'm telling you from someone who's done it, it's better mentally to have it paid off, to pay it off early. Even if you're doing a mixture of both, put $100, put $200, put your tax return towards your house to pay it off early. You will not regret it. I sleep so much better at night knowing my 2 properties are paid off. I have all kinds of equity if I needed to draw some out. And the other nice thing is these are our forever homes pretty much. I mean, could something happen in the future? Maybe that we want to change out. But I don't have to worry about a bank coming in and saying, this is mine because you didn't pay for it. I don't have to worry about getting sick and having something taken from me. I don't have to worry about my wife having to worry about it if something were to happen to me in the future. Peace of mind like that, you can have all the money in the world, it ain't gonna matter. Now, this is a caveat I want to share because it's very important. If you are an investor of real estate, then everybody and their brother is going to tell you not to pay things off, to BRRRR it, or to build up your equity, pull a little bit out, and then make the minimum payments. And from a business standpoint, maybe that's a good idea. That's not what this conversation is about. This conversation is about your personal home, and it can't be compared to an investment style home because that's a whole different game. Now, I'm not telling you what to do. I'm telling you what we did and share how that feels, because nothing felt heavier to me than a 30-year mortgage. Some people may feel differently. Some people love debt. They don't care. That's not me. I hate owing people money. There's nothing that keeps me up at night because I feel like I would rather have everything paid off cash. My cars are paid off. My house is paid off. Anytime I do go into debt, I'm paying it off. I mean, it's just as simple as that. And going and being able to walk around. Do you know how many people look at me when they find out that we've had our home paid off for years and they just look at us and go, how? And it really doesn't take that much. You would be amazed at what throwing an extra $100 every month towards the principal. Now you have to notate it towards the principal. A lot of times people try and make double payments, and that's not the same thing. If you send in 2 full payments, you just paid 2 months. That's not coming off your principal. You need to make sure it's stated that that money goes towards the principal, because if not, you're just making payments and the interest stays there. When you pay towards the principal, you're going to pay less over time. That's where the magic happens. Now, the last thing I'm going to say before we get out of here is this is going to be something based on your area. All right. I know people that have to pay their homes off because their property value is so astronomically high that if you factor that, like it's built in with their insurance into their mortgage payment. So when you factor all that in, there's almost very little going to the actual principal of every payment for the first, say, 15 years. Because they've got this giant insurance rate, they've got this giant land tax rate, they've got this giant, payment, and everything goes in there, but really it's only like a quarter of it is actually, or maybe an eighth of it's going towards the principal. So if you live in a high cost of living area, you would have to take all that into account before comparing it to, say, investing and getting your 8%. Because you may be in a situation that actually financially makes better sense to pay off your property first. So just wanted to share our take with you guys on that, how we came about to where we are. I can promise you the best investment I've ever made is investing in myself to not have debt. Going through and making sure everything was paid off and making sure I can keep everything paid off and not have to re-leverage anything has been the most powerful tool to build wealth. Because the money I would have been spending to pay the mortgage, in our example, let's say that $1,000, I can now invest. But I need hundreds of thousands of dollars less in retirement now. As we strive towards financial independence, I need way less money. Way less money. Because I don't have to have, the toppy top insurance anymore. I can have a mid-class quality insurance through Progressive. So my home insurance went down when the property got paid off. Everything I pretty much do now is very simple because I don't have to factor in paying a rent or mortgage. And that is the most powerful tool you can have. Close your eyes and envision a world where you don't have to pay rent or mortgage anymore, and tell me how much more powerful and wealthy you'll be. And with that said, if you haven't already, and I don't know why you wouldn't have, go down, hit subscribe, hit the notification bell so you see all of our upcoming videos. Give us a like. Let me know down in the comments. Are you working to pay your home off early? Have you already paid your home off early? If so, well done. If not, think about this. Do the math each way. See which way works best for you. And with that said, I'll see you guys in the next one.